Hey everyone, so for today's segment I wanted to go over the Section 83B election for startup companies. Now I'm going to cover this for startups, but it also applies to seasoned companies. It's really any kind of C corporation that wants to issue stock to new employees or officers, directors, or key other like C-suite personnel, right? So if you're hiring a new CEO, CFO, you might want to entice them to come join your new startup company by issuing them stock. And so for the startup context, we'll go through kind of generally what the rules are, what types of stock you're going to see, and then what the tax implications are, and how you go about actually making the election and filing with the IRS. So just to start, that top bullet point there, this is really important to remember because you'll see this flow through the whole exercise here. When a U.S. taxpayer gets any kind of compensation, they've got to report on their tax return, right? If you're an employee and you're working for a company and you're getting paid, it's compensation to you, no matter what form it is. So obviously the most popular one is cash, right? People get paid in cash for the most part. It's deposited in your bank account. That's easy. Now we're seeing a new wave of companies paying their employees in cryptocurrency, right? I mean, Bitcoin and Ether are very popular in that space. But it really can apply to anything. I mean, even if it's some sort of tangible property, right? If you're receiving that in exchange for working, you're being compensated for performing personal services, that's taxable income to you. So it's even as a extreme example, like let's say you work for a liquor store and you make $10 an hour, you worked a 10-hour shift, so you do $100 in cash, and then your boss comes to you and says, well, I can't pay in cash, I'll give you this case of Jack Daniel's green label or something like that that's worth $100. That's compensation, believe it or not. You might not get cash, but you still have to report that compensation on your return and pay tax on it. And so that's an important point, because when we talk about being given stock as compensation, the same principles apply, right? I mean, the fair value of the shares you get are income to you. Now, what type of income and when you record it, this is the issue. It depends on what kind of stock you're getting. So there's two main ones, non-restricted and restricted. So there's a lot of confusion that 83B elections should be used or applied to almost any kind of stock grant. That's not the case. Non-restricted stock, there is no 83B election. It's irrelevant, and here's why. When you receive non-restricted stock, there are no limitations on what you can do with it immediately, right? So you walk into a company as a new employee and they just give you 100 shares of company stock. They say, look, there are truly no strings attached to this. You can sell this today, you can sell it tomorrow. If you quit 3 days from now, it's still yours, right? It's still your stock, and so you have constructively received it, all of it, and there's no restrictions. Because there's no restrictions, you just record the fair value of those shares the day you get it. That's it. That's important because with the restricted stock, you might be granted shares, but you actually can't really control them yet, right? I mean, they haven't vested, right? So there's some sort of restriction on it. Most of them are time restrictions, right? It says, here's your shares, but they're not going to vest until, let's say, a 5-year period. So after 5 years, if you're still with the company, then they vest, right? And that's important for tax purposes because the IRS doesn't want you to include in income cash or property that's not actually yours yet, right? If you don't really have control over it, then you shouldn't be recording it as income in the year of the grant. So this is where the 83B election comes in. So let's say if there was no 83B election and you received the shares as compensation, let's say day one is a grant. So again, there's restrictions, you can't use it yet, and then after the 5-year period, the stock vests. If the stock has appreciated substantially in value, on the day it vests, that is the value that's included in your ordinary income. So let's say day one, the shares are only worth $100, and after 5 years of working your ass off, building up this company, now they're worth $1 million. On that year 5 date, when it vests, you record $1 million into your compensation, right? So you didn't record it year one because it hadn't vested, and then year 5, you have the income inclusion. $1 million worth of just ordinary income. So it's subject to your ordinary federal tax rates. Not ideal. The 83B election allows you to make an income inclusion the year of the grant, even though it has invested, and then as the value appreciates and it vests, it's all long-term capital gain appreciation, right? Long-term or short-term, depending on what the holding period is. But obviously, that's much more ideal situation than having to record ordinary income on the whole thing. So that's the big difference between the restricted and non-restricted stock. And so this is why the election is so important for a lot of startups, right? So tax issues for the election, like I said, if you make the election within 30 days, you have to do it within 30 days. You record the fair market value of the stock the day you received it. So for a startup, it's probably going to be quite low. I mean, there's going to be some value to it, right? Because the breakup value of the company is going to have some sort of equity, maybe, but it's going to be low value. Once the stock appreciates and it vests, so there's no income inclusion on that vesting day because you've already done the election. And then when you go ahead and actually sell the stock, you get the capital gain treatment. So now, this is important. The holding period starts when it vests, not when it's granted to you. So if it vests on year 5, you got to hold it for another year before you sell to get the long-term treatment. If it vests on year 5 and then you sell it, let's say 40 days later, you're going to get short-term capital gain treatment, which could be good or bad. I mean, depending on what your other kind of capital, maybe you have capital losses and you want to eat them up then. But ideally, what people do is they wait for it to vest and then they continue to hold it for a little longer and then sell, get the long-term capital gain treatment. So the key points here, really when you don't want to make the election. So when you're granted the shares, really be careful and look at the restrictions, right? Is this vesting schedule, is it feasible or is it too restrictive and I just don't think it's going to work for me where, I might leave the company beforehand, and if you're going to leave the company, then you maybe don't want to make the election because then you're recording income in that year, and then you're going to derive no benefit from it when you leave, right? Because let's say you record the $100 in income because you made the Section 83B election, and then you left, so your stock. You had to relinquish it, sent it back to the company. Well, you recorded $100 in income and never got anything. Now, the numbers matter here because a lot of people would say, well, even if I leave, even if I think I might leave, I'd rather just make the election anyway, just in case, right? The dollar amount is so low, I don't care. What I would care about is if I decide to stick around because I like this company, and then the stock vests and I can sell it for the long-term capital gain treatment, that's much more ideal for me than just saying, well, it's a startup and I'm probably not going to be here and maybe the stock value is kind of high, so I don't want to make the election. That's fine. A lot of people do that too. And then the other big one is if you think the stock is going to plummet, then don't make the election, right? I mean, again, it comes down to what is the value of income you're recording versus what's the actual return. So if you record, let's use a more extreme example. Let's say the stock is actually worth $5,000 in the year it's granted to you. So now you're thinking, okay, do I want to record $5,000 of phantom income in year 1 and then leave it to chance that I might not be here, or the stock might drop in value and then I might only get like $500 out of it? In that case, obviously you wouldn't want to do that because you recorded $5,000 of income and at the end of the day you only got $500 worth of stock. Not ideal. So those are the big points. Again, the Section 83B election, it's really only for restricted shares. If you get non-restricted stock, doesn't apply, doesn't make sense. The big takeaway is, make sure, really look at the value of the shares on the day they're granted to you and kind of what you think the trajectory is of the company and how long you're going to be there. I mean, that's the other one is some of these restrictions can be 5 years for everything, or it's over a 5-year period. So year 1 you get some, year 2 you get some, year 3 that's a little more preferable. But yeah, I mean, really, think hard, before you make the election. But you can't think on it too much because again, it's a 30-day window. You've got to make the election within 30 days of the grant date. So as soon as they give you that grant option to be able to get the stock, you've got 30 days to file the election with the IRS or else it's lost. So Yeah, so that covers it all. Thanks for watching, and I hope to see you again soon. Bye.